Good morning. My name is Maurice Crespi. I'm managing partner of Schindler's Attorneys. We're here today joined by both Edmund Higenbottam and Brett Roberts, who will be discussing mergers and acquisitions during this COVID period. Cobra was founded by IQ Business, Schindler's Attorneys, and engaged business turnaround. And the idea is that we provide pro bono services with our partners. We have in excess of 60 partners now who've all committed to provide their expertise in the various professions and industries. And the idea is they do so by way of private Zoom sessions. They can meet with you or your team, or they can reach out by sending an email to info@cobra.org.za. We have a website, www.cobra.org.za, with an incredible knowledge base. It has all the details of all the funds and all the regulations in relation to the environment that we find ourselves in. So to introduce our speakers today, I'll start with Edmund. He's the Managing Director of Verdant Capital. He has originated and led high-profile transactions across multiple different sectors and geographies in Africa and elsewhere. It has a total of 19 years of experience in investment banking, of which the last 7 years have been in Africa. Edmund has completed 50 transactions in different markets around the world, including in 20 different African countries. He has great experience in terms of debt capital markets for mid-market financial institutions, as well as equity capital raises and M&As in the sector. He also has great experience in capital markets development and served on the practitioners board of NASDAQ in Dubai, and has also advised the SEC in Nigeria and on market capital reforms. Edmund has previously worked at Morgan Stanley, Deutsche Bank, and Renaissance Capital, and has worked in jurisdictions including London, Johannesburg, Lagos, and Dubai. He holds a degree in economics from Cambridge University. Brett Roberts is a director at Verdant Capital. Brett has a total of 15 years of experience in investment banking. Brett has a diverse array of M&A experience gained in transactions both locally and internationally, and has previously worked for the likes of Deutsche Bank, Bank of America, and Rand Merchant Bank. Brett holds an engineering degree and an MBA. Before I hand over to them, I'd like to introduce the remaining panelists. We have Emma Marseille from IQ Business, Rene Klopper from IQ Business, and Gary Barachowitz from Schindler's Attorneys. So I'd like to welcome the attendees on the webinar. I'd also like to welcome the Facebook attendees. To the Facebook attendees, we also take questions. We monitor the chat, so please ask any questions that you may have. And similarly, the webinar attendees, that's what this is about. It's about an interaction, so please post your questions. It makes the discussion more dynamic and certainly more interesting. So I'd like to welcome Brett and Edmund. Thanks so much for assisting Cobra and giving up some of your time to give back to South African business. Thanks so much, guys. Over to you.
Good morning, ladies and gentlemen. And Maurice, thank you very much indeed for the introduction. We'd like to make this presentation as interactive as possible, and I do urge the audience to address any questions to Brett and myself at the end of the presentation. I will now share my screen. Should now be visible. So Brett and I are here to talk this morning about mergers and acquisitions during the COVID-19 period. 2 questions. Can I sell my business in the current environment? How do I go about selling my business in the current environment? So first of all, the short answer is yes. M&A transactions are continue to be agreed every month in this environment: March, April, May, June, July. It is fair to say that M&A deal volumes are lower, have been lower over the last few months. I think it's also fair to say that the current market is not a seller's market. And certainly buyers are very focused on opportunities which are less severely exposed to the impact of COVID-19. There are some sectors in the economy, some types of telecom sectors and others, who've actually benefited from this crisis. And buyers who've got funding available at the current time are seeing this environment as an opportunity to buy assets, to buy good assets that might otherwise have been very expensive, or buy good assets with a strong strategic fit to their businesses. So we look at 4 categories of buyers: private equity, family businesses, JSE listed companies, and BEE holding companies. Before we do that, though, it's perhaps worth touching on transaction volumes in this environment. So this graph here shows the number of M&A transactions agreed each quarter. And we're looking at this time series back to the beginning of 2017, all the way to today. And what you will see is that a very significant number of M&A transactions have been agreed in Q2, which of course is the period over which we've had the maximum impact of COVID-19 in South Africa and the maximum impact of lockdowns. I'm going to make this slightly larger so you can see the numbers. So clearly, if we look at this period of time over the last 3-4 years, M&A transactions announced certainly been less over the last quarter, less than if you look at the quarters before over this last 3 years, but actually still a large number of transactions that were being agreed. I think it's 70 something that's been agreed. Key buyer categories. Private equity. Private equity globally, including in South Africa, have been viewing this crisis as an opportunity to buy good businesses. And to buy good businesses probably at a more attractive valuation than 2019 or 2018. And that's true the world over, and it's true in South Africa. And that's been validated by our recent discussions with the leading private equity firms in South Africa and the middle market private equity firms in South Africa. I think it's fair to say that in the 2018-2019 crisis, private equity was less aggressive or less active. And I think with hindsight, the private equity community actually wishes it had been more active in that last crisis. And in this crisis in 2020, albeit very different to 2008, 2009, the private equity community is looking to transact. Now good opportunities present themselves. What I would say, however, is recent private equity fundraising in South Africa has been smaller than previous vintages. So the fund sizes today of the leading firms and of the mid-market firms is probably about a half or 3/4 of the sizes of the funds which were raised 5 years ago. And that does have an impact. Next buyer category, family businesses. Family businesses are looking to exploit synergies by putting their business together with a business that is potentially for sale. So acquiring businesses in a similar sector, or potentially businesses which are represent a vertical integration, customer sectors or supplier segments. Family businesses typically have a long time horizon. They typically represent generational wealth. But that said, family businesses with their own succession issues, i.e. family businesses where the principals are in their 60s and 70s, probably won't be so interested. JSE listed companies. The appetite of JSE listed companies to make acquisitions really does depend on the company in question and how they're faring in this crisis. But it's fair to say that JSE listed companies have a much broader access to funding than private companies generally. And of course, the South African listed market, the Johannesburg Stock Exchange, has a very high proportion of listed holding companies and conglomerates, be that Bidvest or similar. And those sort of listed conglomerates, listed holding companies are much more important as a segment in South Africa than other markets. And they look at making acquisitions across all sectors. Finally, BEE. And of course, we do need to mention this important buyer group. There has been a lot of talk in politics over the last 3 months that post-COVID, government policy needs to be aligned to promoting more inclusive economic growth and a greater degree of transformation of the South African economy. So there may be certain reforms or certain changes to the BEE regime post-crisis. There may be some other incentives relating to empowerment. Even leaving aside potential policy changes going forward, it is clear that BEE and empowerment may provide benefits for a BEE buyer, particularly in certain sectors. So certain businesses which are selling to state-owned enterprises or selling to the mining sector or selling into the supply chain of a variety of sectors, then there may be procurement benefits for the buyer if the buyer is BEE. There may be an opportunity for the buyer to take the business to places which the existing owners can't. Some BEE holding companies have capital, and they are the focus in terms of the businesses which we talk to. And others are more dependent on state actors for funding. And as we've all seen, the South African government has just benefited from a new 4 billion facility from the IMF. I don't think funding from state access, Q3 2020, is readily available right now. So our focus is very much on BEE companies who have capital of their own. So can I sell my business in the current environment? The short answer is yes. The short answer is that transactions are being successfully negotiated and successfully completed. And if it's a good time for you to sell, if there's a good reason why you want to exit your business, and your business is doing well, or your business is doing okay, or your business was doing well before the crisis, then very likely there is a buyer universe who would look very seriously at the acquisition, and there's an opportunity to complete the transaction. How do I go about selling my business? Before you even start making preparations of marketing materials or reviewing potential buyer lists or preparing teasers, preparing non-disclosure agreements, very, very important to identify the key issues that relate to your business and the key issues that may relate to selling your business. These issues on this page are not really issues relating to COVID-19. These points are true 2020, 2019, 2021, 2022. I'm going to take you through the highlights of the issues on this page. Your financial statements. Are your financial statements reflecting the true performance of your business? Are they underreporting or overreporting the profitability? Many of our clients come to us looking to consider selling their business, and it's clear early on in those discussions that the profitability is underreported in the financial statements. You might ask, why would somebody looking to sell their business underreport the profitability? But actually, some clients, for tax management issues, maybe putting some lifestyle expenses through their companies. And obviously there's certain tax advantages for doing that. And that then underreports the profit of the business. And that reduces the value of the business at the time of sale. Will your financial statement stand up to due diligence? A number of these issues relate to the fact that any buyer will need to do detailed due diligence on your business. And as your advisor, we need to address those issues ahead of time so that when we do face that due diligence, we come through with a clean bill of health. Leaving aside the financial statements, your business plan more broadly. So in order to sell your business, you need a realistic business plan for the next 3 to 5 years. And as an advisor, that's something we would help you prepare. And in preparing that business plan, we would also review key issues in your business. Are you too dependent on a key customer? Are you too dependent on a key supplier? Are your key contracts in good standing? Do you have the right amount of working capital in your business? Not enough working capital in your business, it will hold back the trading performance. It will reduce the profitability of the business and get you a lower valuation. If you've got too much working capital, maybe your receivables are too high, maybe your inventories are too high, that will also have a negative impact on you at the time of sale, because more working capital means more bank financing, and when the buyer looks to complete a transaction with you, they will look at a valuation for the business, not for the equity. They'll look for a valuation for the business, and from that business valuation, they will subtract the amount of debt, and that then leaves the equity for you. If you've got too much working capital, it means you've got too much bank financing to support that, and more bank financing means a lower equity value. Due diligence issues. Are there legal issues? Are there outstanding disputes? Are there threatened disputes? Clearly, if there's litigation threatened against you as a business owner prior to sale, then that's a big due diligence issue. If there's litigation, you're threatening against another party, a customer or supplier, or for any reason, then that's less of an issue, but it's still an issue. Valuation. What is the business realistically worth to a buyer? Not to you as the current owner, but to a buyer. What is the business worth? Does that realistic valuation work for you? If you're selling your business today and you're 72 years old and the sale proceeds is a significant part of your retirement planning, how much do you need? Very often, the buyer will require the management to stay in the business for a period of time post-acquisition. So for a private equity buyer, that period of time might be 3 to 5 years. For a buyer in the same industry as you, it might be 1 to 3 years. So if you're 72 years old today and you're selling your business, can you stay in this business for another 3 to 5 years, 2 to 5 years? Do you want to emigrate? Are you fit and healthy? Can you see yourself continue to perform this role for the next few years? If you don't sell this business today, and instead you plan to sell the business in 5 years' time, in 5 years' time, you'll be 5 years older. At that point, will you be able to stay in the business another 2 to 5 years? Alignment. If we look back at our experience as Verdant Capital, the key reason for M&A transactions not to complete, where our projects have not completed, is not lack of interest from buyers or lack of interest from investors. It's certain shareholders changing their mind and deciding not to sell. Or it's different shareholders within a client who want to sell and different shareholders who don't want to sell. So it's very, very important at the outset to get an alignment between different shareholders on that decision to sell. Clearly, if you're the sole shareholder or the vast majority shareholder, it's just up to you. But if there is a shareholding group, then make sure you're aligned with your partners. Finally, make sure you're aligned with your heirs. Are your children involved in the business? Do your children expect to continue to be involved in the business post-sale? If one of your children has a senior role in this business, is he also willing to be locked in for 2 to 5 years post-sale? So be ready for the due diligence and be ready to make the right impression on bidders. This process of identifying issues, this process of getting clear alignment and a clear roadmap, working through these issues with a client might take a month, might take 6 months. Whether it takes 1 month or 6 months, make sure you resolve these issues and any other issues before getting to the start line. Brett, I'll hand over to you to talk more about the roadmap for sale.
Thanks, Ed. So on this slide, we provide an overview of how an M&A process flows for a typical competitive sale process. At a minimum, a transaction takes around 6 months, but could take considerably longer, which will be dependent on the level of preparedness as well as interest in the business. The first phase of the process is the due diligence readiness, which is what Ed has just talked about. DD readiness is critical to ensure that your business will allow the DD to be adequately completed by the potential acquirer and that red flags issues will be mitigated as far as possible. Attaining readiness may take some time to finalize, and therefore the exercise should be undertaken well before the intended date to launch the transaction. The next phase of the process is the marketing preparation phase. There are 4 aspects which form part of the marketing preparation phase. Firstly, identification of potential bidders. Secondly, preparation of marketing materials. Thirdly, preparation of a virtual data room. And then fourthly, preparation of a sale and purchase agreement. The output from this phase will be used throughout the execution phase at various points. Looking at prospective buyers, it will be important to understand the types of buyer that are likely to have an interest in your business, as this will improve the prospects of success. Some of the types of buyer were covered earlier in the presentation. In order to maximize the prospects of success, one generally needs to think outside of the box as the prospective buyer universe, as to the prospective buyer universe, and not only identify the obvious buyers. Keep in mind also that different buyers have different investment criteria, and therefore the buyer universe may be impacted by the structure of the transaction. So, for example, private equity in many cases prefer to acquire significant minority positions, whereas a trade buyer will seek a control acquisition of the business. The marketing materials comprise primarily an information memorandum, which provides a detailed overview of the business. The document is an important tool to sell the business and needs to detail the attributes of the business, as well as the financial history and prospects of the business and how the business is differentiated from its competitors. It also needs to present a compelling investment case for why a prospective buyer should be interested in the business and be willing to pay an attractive price. The virtual data room contains detailed information on the company and includes information such as corporate governance information, detailed financial information such as financial statements and management accounts, business planning documents, commercial aspects such as key contracts, details on legal risks facing the business, tax status, human resources information. After the marketing phase, the transaction moves to the execution phase. At this point, prospective buyers are contacted and the process of engaging with them commences. The initial phase of execution is to engage with prospective acquirers to gauge potential interest. If there is interest, prospective buyers will typically sign a non-disclosure agreement and receive access to the information memorandum. They'll be requested to submit a non-binding offer. Those prospective buyers which submit non-binding offers which meet the seller's valuation expectations will be invited to undertake a detailed due diligence investigation on the business, which will include access to a virtual data room, as well as be allowed access to management to discuss the business and ask questions and address key areas where there are potential issues. The detailed investigation will culminate in final offers accompanied by the prospective buyers marking up the SPA. The most attractive bid with the demonstrated ability to fund the transaction would be selected for final negotiation and execution of the SPA. Fulfillment of any suspensive conditions, such as Compcom approval, will lead to transaction completion and funds flow. Throughout the execution phase, it is important to maintain competitive tension so that prospective buyers put their best foot forward in terms of their offers. Let's reach the next slide. Next slide, yeah. In our experience, the benefits of hiring an advisor far outweigh the costs when it comes to executing an M&A transaction. The advisor will be better positioned to identify potential issues which can be worked through before launching the transaction. The advisor will also understand the key aspects that the marketing material should address and therefore help create a compelling document. The advisor will be well positioned to significantly broaden the buyer universe that will be targeted, and the advisor will be able to provide tactical advice to get the most out of bidder engagement. Considering these aspects, the net impact will be to help to de-risk the transaction. And for many clients, selling the company is a once-in-a-lifetime event, and therefore it is important that the seller is best positioned to maximize outcome.
And Brett, as you mentioned, for many clients, you sell your business once, and that's a culmination of your life's work, and that of course makes it incredibly important to de-risk. But for very many highly successful, highly experienced entrepreneurs, they don't actually have experience selling their company. Kept it, they've run it, and that's why it's such a success today, because they've been doing the same thing for so many years. But it does mean that at this critical juncture, within their immediate circle, within their team, CFO, key other stakeholders, they don't have experience of selling companies. Verdant Capital, we sell businesses constantly. We complete anything from 5 to 10 transactions of this type or similar every year. And we've seen it all before. We've seen the pitfalls. We've seen the issues. We're able to preempt the issues, whether there's issues in your business or whether there's issues related to negotiation. We're able to preempt them and get the best possible transaction for you. And Rene and Maurice, I see some questions are starting to come through on the chat.
Yes, I see there's one from Renee. What strategies are JV private equity guys using during COVID to leverage their cash flush positions relative to sellers, and how do sellers parry this?
We do see some private equity buyers looking for some downside risk mitigated structures when acquiring businesses. That may be businesses which have had a COVID impact, and the buyer is saying, well, actually, I will buy that business. I do see the long-term potential. I do see 2021, 2022. I do see post-COVID environment, but I don't know how long this difficult trading environment is going to last, and I want some risk mitigation because of that. And that structure can be the best way of getting a transaction completed, but it is important to have a competitive process. Important to have a competitive process with multiple different buyers and ideally multiple different buyer groups actively looking at the transaction. Make sure that taking into account the terms in their entirety, valuation, as well as potential earnouts, as well as potential downside protection. Make sure that the terms in their entirety are the best terms available to you for your business.
There's another question, Edmund. What size companies do private equity look at?
Well, it depends how big the private equity firm is. But in general, we see bid from private equity for relatively small transactions, maybe starting at 20 or 30 million rand. And we see that going all the way up to maybe R1 billion. And if it's an international private equity transaction, Verdant Capital has extensive international relationships with buyers, not just private equity. It could be multiple billion.
So we have one relating to valuations. It's Emma asks, how has COVID impacted valuation of businesses being sold compared to pre-COVID? Also, has COVID affected the timelines you've mentioned in your timeline?
So maybe I'll start on the timeline point. In our current transactions we're working on at the moment, we have seen some small delays because of COVID. A lot of those times it's just out of logistics, doing a site visit. If the technical team is coming from overseas to do a site visit, for example, on a food processing plant, clearly the borders are closed, so you can't do that site visit. So there are some small logistical delays that we're having to factor into our processes as we go along. But ultimately, that might add 1 or 2 months to the timetable. And those processes are still progressing, and those processes will still complete successfully.
And I think on valuation, so I'll take the point of valuation. So I think on valuation, I mean, clearly earnings for businesses have been impacted, and by virtue of that, valuations will come down somewhat. However, there are mechanisms to try and claw back at that, and that is through mechanisms such as earnouts and those sorts of things.
An earnout is, simply put, let's say I'm selling my business to Brett, I will agree a price on day one. Maybe I'll agree a price of 30 million rand for my business. I will continue to operate the business as MD for 3 years. And if my business achieves certain financial targets, then that sale price is increased. I earn more. The business is earning more. As a seller, I get a bigger consideration.
I was wondering if you guys can answer this. What has happened? Has there been a paradigm shift in relation to the types of transactions that you guys are looking at? You know, in a post-COVID type environment, you know, are there particular industries that are now absolutely off limits?
Well, Maurice, I was approached by a client this morning to sell a budget apart hotel property company. And unfortunately, we did have to tell that client that we did not see a market for that company in the short term. And we would recommend that we have another discussion in 3 months' time. So certainly there are 1 or 2 sectors that have been very severely impacted by the current COVID crisis and about how people do business. Most sectors have been impacted positive or negatively, you know, by a moderate amount. You know, most businesses which are performing and operating profitably pre-crisis are profitable today. Some of them slightly less profitable, some of them slightly more profitable. I mentioned
sorry, carry on.
I think you asked what sectors buyers are looking at. So I think sectors are looking at most buyers, most sectors with 1 or 2 exceptions. Certain sectors are performing very, very strongly in the crisis. So things such as business telephony. So companies who provide wholesale infrastructure to telecoms infrastructure, or people who provide different types of internet connectivity, ISPs, providing that service to companies, to retail. Obviously, the dividing line between businesses and retail has been blurred when it comes to things like the internet. A lot of people are working from home, and they need to upgrade their home internet. But is that a business customer or a home customer? So the lines have been blurred. But there's lots of sectors which are performing well in the crisis, or even performing better. But you don't have to be one of those sectors to complete a transaction.
We have Peter asked, what kind of valuation methodologies are you guys using at the moment?
Typically, the valuation methodology is very highly negotiated. That valuation methodology might be a combination of methodologies. It might be an earnings multiple, looking at comparable earnings multiple in the listed market, but also comparable earnings multiples in the prior transactions. And obviously at Verdant Capital, we've got access to databases and we've got proprietary information sources which help you calibrate that valuation expectation and help that negotiation. Discounted cash flow is perhaps the most fundamental valuation methodology. It's looking at, as we sit here today in July 2020, if we look forward over the next 5 years, how much money is this company going to make? How much cash is it going to throw off? And then it applies a discount rate to that cash flow. It discounts the future cash flow year by year going forward, and then aggregates that discounted flow of cash. And that's the most fundamental valuation, but also it's the most subjective because it requires making assumptions about the future, and no one has a crystal ball.
Joanna has asked, can you sell a loss-making business?
Well, before I get back to Joanna, a final valuation methodology, which is important, particularly in smaller companies, is net asset value. And you want to be very careful about net asset value, because if a business is not making any money, it doesn't matter how many assets it has. but it is an important point of reference to when one, you throw that in the mix with the other valuation methodology. Can you sell a loss-making business? Yes, yes and no, right? So if it's a business that has assets, and when I say assets, that could be tangible or intangible, that somebody else wants, that are synergist to their business, then yes, we can sell loss-making businesses all day long. Is it a business that needs to be transformed? Is it supplying to the mining sector or the government, and it doesn't have the appropriate empowerment credentials to be a success? Can we sell that business? Yes, but we have to sell it to a company with the right empowerment credentials. So does the business have the wrong management? Is it a nice company that has been doing well successfully, but is currently run by the wrong people? We can sell that company. But the buyer is going to change the management in that case. If you've got a loss-making company that doesn't have anything else going for it, then it's difficult. If you've got a company that's making losses in the short term because of a specific COVID-19 impact, but it's a hell of a good business otherwise, yes, we can definitely sell that business. And I can think of at least 3 transactions at the moment we're working on which fall into that category. Very, very nice businesses, lost money hand over foot in Q2 for specific reasons we don't need to go into, we're all aware of. And yes, we've got a range of buyers and bidders looking to buy or invest in those companies.
What are you guys doing, just back to the question of valuations? If you were to apply a future discounted cash flow methodology, what are you guys doing in relation to the next year or 18 months? What are you predicting?
Well, it depends on the sector, but we expect a cautious recovery in most sectors as life normalizes again. And when I say cautious, we never know when there will be, we never know what is going to be the progression of the pandemic. We don't know what is going to be the progression of the disease in South Africa. There could be new restrictions in 3 months' time, 6 months' time, or 9 months' time, and they could have an impact on business. So while we expect that H2 will be better than H1, and H1 will be better, H1 2021 will be, but the first half of 2021 will be better than the second half of this year, and so on. We don't know that for sure. So we have to be a little bit cautious about those assumptions and probable recovery.
Have you, it kind of ties in with the earlier question, but I think it's pretty relevant to Cobra, because Cobra is about distressed businesses. And, there's the distressed businesses are now regarded as a potential market when it comes to funders and lenders. And, we have legal mechanics such as post-commencement finance that we find in our Companies Act that are useful tools for these kind of transactions. Where are you in relation to that space?
So we do assist in business turnarounds. That business turnaround is through refinancing your debts with new debts or with equity. Whether that's selling part of your business in order to reduce leverage, even selling your entire business, or whether that's negotiating with your existing lenders concessions around principal payment terms or even principal payment amounts, covenant packages. So we are involved in business turnarounds, but our practice is strictly out of court, and we're not involved in court processes or post-court processes. And actually, we find value is best protected for all stakeholders by getting to a negotiated position before getting lawyers and courts involved.
Yeah, that makes sense. But just bear in mind, just for the audience, that
Very-
Cobra is about distressed businesses and then plugging you guys into it. So what we do is we try and keep the businesses completely, away from court. And what we've found in this environment is that people are not interested in going to court. There's a degree of benevolence amongst debtors and creditors and business partners, and the various business relationships are very, very different in this environment.
I agree with your comment about benevolence, but also its self-interest in many cases. So we're currently doing a recapitalization combined with a renegotiation of existing loans, and this is for a financial institution which provides payroll loans and provides some credit for small businesses. It's a small institution, it might be the equivalent of 300-400 million rand in terms of loans. And one of the big lenders to that institution is KfW, which is the German Development Bank. And we're involved in renegotiating their loans with their existing lenders. And I think it is fair to say there is a degree of benevolence, but equally it's self-interest. We'll have that conversation with that lender. We're not with the lender group. We're not afraid of having that discussion with that lender group. That we're looking for a solution that keeps the company performing as a going concern, that enables the business to operate without the demands of the lenders, effectively pushing the train off the tracks. And we're not afraid of saying to that lender group, this is up to you. We're not forcing you into this negotiation. If you want to, you as a lender can accelerate on your loans. You can take court action. But if you do that, you'll get a worse outcome than a negotiated solution that keeps the business going as a going concern. And in many cases, that's combined with a sale process. We'll say to the lender group, we need 2 years breathing space. And if you give us that time, either we'll sell the business or we'll refinance the business in that 2 years. One way or the other, you'll get your money back. You may not get the exact contractual terms, the exact interest rate. You're not going to get the payment schedule, but you'll get your money back if you give us that time. If you don't want to give us that time, go to court and you get a worse outcome.
Great. Just a comment to make. Sir Richard Dawkins will tell us that benevolence and altruism is always in our self-interest, in his book, 1970 book, The Selfish Gene. We have another question. What success rates do you have with mergers compared to acquisitions?
So mergers are unusual, right? A merger in common parlance means, I'm selling my company, but actually rather than selling my company, I meet Brett and Brett says, well, I've got a similar company. Why don't we merge it into two? And we'll each continue to own the company and we'll each continue to play a role in operating it. So that's a merger. And actually mergers are quite unusual, both in terms of, medium-sized businesses and also in the large cap sector. Typically, one party is acquiring the other. Typically, you've got one set of shareholders who want to sell and you've got another company that wants to buy. So mergers are rare. What is our success rate? We have demand for all our projects. We have bid from buyers for every transaction we take on. 1 or 2 transactions we can't support because we don't think there will be bid from the market, from buyers. But we have demand for all our transactions. But yes, from time to time, the transaction doesn't complete because the sellers change their mind. And ultimately that's capitalism. If you own a company, it's your company. There's no, you don't have to sell it if you don't want to. Right? And sometimes clients do change their
I'm curious, have you found that in recent transactions, so post-COVID transactions, the transaction documents or the agreements contain now new clauses dealing with the situation? You know, for instance, I'm just thinking of profit warranties and pre-COVID transactions, all the deals that you conducted last year. I mean, chances are those are not being met. So my question is, what's happening to those transactions, and what is one doing about it contractually now in relation to future pandemics or acts of God?
So we're not seeing any of our existing transactions unpicked because of the COVID crisis. In terms of transactions we're executing today on behalf of clients, we are much stricter in terms of things like material adverse change clauses, or much stricter about force majeure clauses, and similar outs for the buyers. So clearly, if we're representing you to sell your company, we need to be careful that the contracts are as tight as possible and leave the minimum wiggle room for a buyer. So as a whole, we've been successful in negotiating material adverse change clauses, which are both more narrow and more specific. So a buyer can't say 2 months down the line, well, actually, COVID-19 had a bigger impact than I thought it was going to have, or it's the impact lasted a bit longer than I thought, so bad luck, I'm not going to go ahead with the deal. So we have been able to be much stricter and much tighter on that for our clients.
Are you guys involved in managing? Are you jumping in and assisting in relation to defaults that have occurred in relation to transactions, let's say, in the last 3 years? You know, what's happened there? You have a relationship with the parties, you know both of them. Here's an act of God. It's a no-fault-based breach in a sense. Are you guys jumping in there? What's happening in that space?
No, we're doing that, and as you say, Maurice, it's in many cases an act of God, and negotiation with creditors is typically a win-win outcome, and we are doing that for certain clients, renegotiating institutional cap funding, or renegotiating with existing lenders, or providing and arranging new financing. And typically, you only renegotiate your loans if you're in default, right? So not many people start those negotiations before default, before they're in breach. But typically you've missed an interest payment, or you've missed a principal payment, or you breach your covenants, and it's time to get around the table and agree something that's in everybody's interest.
We have another question from Emma. Thank you, Emma. Given that the valuation of a business has been impacted as a result of COVID, what options are there to maximize value when selling?
Competition. Somebody once said, the value of a business is what someone's willing to pay for it. Not true. The value of the business is what the second guy is willing to pay for it. Because the value of the value that the second guy is willing to pay for it is what the first guy, who wants the business the most, has to outbid to get it. If you want the best value, you need to keep the process as competitive for as long as possible. And when Brett set out that timetable a few minutes ago, one of the points he kept coming back to at each different juncture is how we as a firm, how we Verdant Capital use devices to keep the process competitive for longer.
Brilliant. I think that's it for questions. I don't know if there are any other questions, or Brett, do you want to add anything?
just one more point on the maximizing value. I think we talked about it a bit earlier. So there's competition, but there's also looking at structures to allow value unlock later, and that's the likes of earnouts.
One more question, I think.
Go for it. Is there another question? Yes.
Emma. Oh, so it says Emma. Thank you for joining. Well, yes, thank you all for the audience for joining. I very, very much hope that this panel and this presentation has been useful. We'd love to hear from you. Our website is www.verdant, VERDANT-CAP.com. Our email contact details are on that, and we'd love to hear from you. We'd love to help, and we can have a discussion in terms of what your plans are for the next 24 months. It doesn't have to be a sale process. We're starting in August. We can plan ahead for next year.
And brilliant. And if you didn't get those details, please email us at info@cobra.org.za and we'll send them to you. And if you want to set up a Zoom session, we'll arrange it via Cobra. We'll tee that up for you, and we'll, if need be, add additional professionals. If you need advice on certain aspects of your business, we can throw those professionals in. And yeah, that's what Cobra is about. So thank you very, very much to the attendees and to the panelists. Thanks so much, guys. This was really, really insightful. We're going to ask that you come back. This was absolutely brilliant. And yeah, thanks so much. Until tomorrow, to the attendees. Great.
Thank you for having us.
Thank you.